couple of other pointers that the street has been debating about, and that's the insurance stocks. They've been all over the place. To help us out with, the first take with regard to the insurance companies, we have Ms. Vibha, the CEO of HDFC Life, who joins us on the show. Hi, Vibha. Good afternoon and good to see you, and thanks a lot for joining in. Well, one factor is been on with regard to the changes in taxation, particularly for the new structure, and the other one is on ULIP. Let's take the first point first. Since there will be some kind of leeway given, particularly on the new structure, the fear is that it could result in fewer people taking insurance and in that regard, hitting your volumes. What do you have to say with regard to that?
Couple of points here, and thank you for having me on this show. The first point is it's widely available data that almost 70% of taxpayers have moved to the new tax regime. That is the first data point. Second data point is with our own policy holders, less than 2%, our analysis shows that less than 2% are dependent on tax, or tax being a reason for them possibly buying life insurance. So really a non-material number, and even that would reduce as we go along. So we have moved a long way from a tax being the reason. This might have been certainly the case a decade ago, but now given innovation in the sector and many other products and emphasis on more and more of protection, I think at least certainly for HDFC Life, but I think even broader for the sector, just given the number of people who moved away into the new tax regime, I don't think that is really a dampener in any form or shape.
Well, that's heartening to hear, actually, Vibha, not just from a market perspective or from a policy perspective, but people are taking insurance because of, for the core interest with regard to insurance, not because of, tax exemptions. Yeah, Prashant.
No, Vibha, hi, afternoon, Prashant here. So you're saying that 2% of HTC roughly contributes about 2% of the new individual premium. That's what you're saying?
ATC is overcrowded, as you know, Prashant. There are many, many things, and if you're salaried, in all probability, when we do an income proxy, we know that even if they did not buy life insurance, their contribution to Provident Fund, other things, ELSs and so on, would have consumed or utilized ATC anyway. So that was not the primary reason or the reason at all for them buying life insurance.
The other change was this redemption of unit-linked schemes, right? And there, for a brief period, there was a misunderstanding. There was a little bit of fear that maybe, it's being taxed at capital gains. But then clarity, Yash told us that it was being added to your income tax, charged at the marginal rate. Now actually it is going to be taxed at 12.5%, which is the capital gains tax. Is that the correct interpretation?
Yeah, absolutely, and actually it's significantly better. So let me just deconstruct, the somewhat of a misunderstanding in terms of what was intended. First of all, the language, and I'm just referring to the language mentioned by the FM, is bringing clarity in income on redemption. So it was to bring clarity and not to introduce anything new, anything that was significantly adverse. Now, post 2021, 1st of February 2021, there was a cap of 250,000, and anything above 250,000 annual premium was taxed, and it was taxed as and continues to be taxed as capital gains tax. Up to 250,000 was tax-free. Now, before the policies that were sold before 1st of February 2021, if they adhered to certain conditions, for example, number of times of the ratio of premium to sum assured, then it was completely tax-free, regardless of the quantum. However, there were some other policies that didn't satisfy this multiple of sum assured, and they were being then taxed and continuing to be taxed until today at the highest marginal tax rate. So all that the provisions now unveiled are going to do is to simplify it, to say that anything that is not compliant will now be taxed under capital gains tax, instead of all this hybrid of earlier was a marginal tax rate and so on. That's all there is to it.
Okay.
And just to add on that, if we were to look at, say, hypothetically, if I had bought a policy before February 21 and say I had only a 6 times sum assured, then that would have not been even then eligible for under Section 1010D. And so I would have been paying at highest marginal tax rate. So if a taxpayer has been paying or would have paid a maturity proceeds at 30% tax, now it will be at a capital gains tax rate at 12.5% tax. So actually there is a benefit for those policyholders that would have bought their policies before 21.
Okay. Ma'am, the third important announcement from the insurance sector is opening up the sector to 100% FDI. Will it impact listed players like you, one? And two, how does this change the competitive dynamics? Would some of the unlisted players now get that 100% FDI and therefore become a lot more competitive and aggressive?
While I welcome 100% in insurance, being pragmatic, even when it went up to 74%, it's not like there was a lot of money flow. What could happen is there could be some foreign insurers or foreign investors for whom it's either 100% or it is zero. It could attract people like that, or if they want full control and don't want a partner, say if their brand presence as an insurer somewhere else is extremely strong. But barring that, will it make a huge change in dynamic to the competitive intensity? I don't think so. I think what is really important is some sort of regulatory certainty. I think that is the biggest aspect that will attract flows into the, why only insurance sector, but any sector really. And that's really what could be a game changer in terms of certainty on regulatory outlook.
All right. Thanks a lot, ma'am, for joining in and giving us all your views on the space, assuaging some of the fears that the street had with regards to shift into the new tax regime and that impacting business for you as well. But,